Wall Street is in retreat. Gains made earlier this week are all gone. The sell-off took place after a series of tweets by U.S. President Donald Trump. He says trade negotiations with China are already underway, and he'll sign a deal he thinks is fair. But it came with a threat.
I am a tariff man. When people or countries come in to raid the great wealth of our nation, I want them to pay for the privilege of doing so. It will always be the best way to max out our economic power.
Beijing's response was more measured.
We hope the US can meet China halfway to follow through the consensus reached by our two leaders to promote the steady and healthy development of our bilateral relations and bring more good news to the people around the world and the two countries, delivering more tangible benefits to them.
It was China's initial silence, in contrast to Trump's exuberance, that called the value of the truce into question. After meeting with his Chinese counterpart Xi Jinping in Argentina, Trump said he'd gotten Beijing to agree to buy more U.S. agricultural goods. China's been quiet on the issue, and has also been mum on another Trump claim, that tariffs on U.S. cars would be nixed. The world's two largest economies have already imposed tariffs on $360 billion worth of each other's goods. That's $250 billion worth of things made in China and $110 billion worth from the U.S. Experts say people in both countries should manage their expectations.
I think the majority of people don't understand economics. They think manufacturing can really return to the US. If the US can make things worse for China, those factories will return to the US. We know this is impossible. Costs in the US are just too high, and people feel the same in China too. Many people think China can defeat the US and become number one. That's impossible, but many people have this fantasy.
American and Chinese officials have given themselves 90 days to reach a deal. If they fail, more tariffs are likely to follow. Paolo Montesillo, TRT World.
Well, let's talk to David Levine, who joins us now from North Carolina from the investment company Odin River. David, how significant are the China-Trump mixed messages on the market's fall?
Well, Jamie, thanks for having me. I think that, of course, it matters. Of course, the trade war with China is an issue. But I think it's also important to put it in context. The markets have been selling off around the world all year. China's been in the bear market all year. In October, the U.S. stock markets took a plunge and global markets have been weak. So while, yes, in the recent days, the trade war headlines have moved markets both positively and negatively, I think it's really important to keep it in the broader context. And there's actually quite a bit going on that has weighed on markets today.
Some commentators writing about all the red on the stock market boards are suggesting this is partly because of automated selling, so-called machine selling. Would you go along with that?
I think that's probably correct. One of the things that's happened is as the volatility has picked up and as, say, the S&P 500 has reached critical levels, quant strategies have begun selling. In fact, yesterday at midday, I think some people have reported up to 90 billion of some of the selling that came in the middle of the day was due to quantitative strategies. That seems likely, and it seems likely to continue given the predominance of some of these strategies in the daily activity of the markets today.
I mean, for people who are not involved directly in the business world, I mean, this will sound slightly alarming that there isn't a human hand involved in this selling. It's a load of clever computers following algorithms.
It is alarming. On the positive side, if you look at 2017, the markets went up, 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 up. The S&P 500 had a Sharpe ratio of 2.7, which should never happen. But the reason for that, on the upside was due to the machines kind of, driving stocks up. So you kind of can't have it both ways. If the machines will help on the buying side, they're ultimately going to come and, participate in the selling side, which I think is what's happening now.
When you look at the analysis online written over the last few hours on the events of yesterday and the sell-off on world markets, there is this wider narrative of fear of a downturn, isn't there?
Absolutely. I think that's right. And, in a way, if you look at how quick people were to reverse their positive sentiment, that fits with the backdrop of pessimism and fear. In a way, the hopes that might come from a tweet of a steak dinner settlement with China. Maybe they produced a fleeting rally, but once people peeled back the onion and looked at the substance of the deal, which, frankly is very early stage, there's 90 days of negotiations. And I think once people started to kind of realize, the hopes that they had maybe hoped for were not really matched with the substance of the deal, it made sense that the markets corrected yesterday in a much more, in my opinion, much more appropriate fashion.
David, it might be a slightly unnerving time for people who hold stocks that have taken a tumble, but is this also a good time for buying for people trying to get into the market?
Unfortunately, I would urge caution. If you look at the stock market over history, there's cycles that go up, they go down, and we've been in a very, very strong upcycle for a very long time, a record bull market, and all good things come to an end. So, especially after a day like yesterday, I don't think, from my perspective, caution is advised. The markets are volatile. Again, if you look outside the United States, you have bear markets all over the world. So, now that the U.S. is catching up with the rest of the world, only natural that might continue.
We've talked or suggested U.S. markets and the effect of Donald Trump and China for the last few moments. I just want to focus for a moment on the effect of Brexit on not just British markets, but the wider European markets.
Yes, so that was actually a very important thing that happened in the middle of the day yesterday. Some people actually think that led to some of the quantitative selling that happened around midday. So the Brexit negotiations, as you know, have been ongoing. But again, in the European Union, Brexit is one of two major things that's happening right now, which is, there's another negotiation happening between the European Commission and Italy. So this political instability in Europe is very real. It's troubling, both Brexit and the Italian negotiations. And those vulnerabilities are showing up in European markets. European markets have been weak year to date. So indeed, I think Brexit was a very important thing that many overlooked yesterday. And actually, I think it did show up in some of the markets. And some of the quant strategies were probably informed by that. A very important piece of news that happened yesterday.
As you suggest, it's very easy going through all the newspapers just to think that Brexit and what's going on in Westminster and Theresa May trying to get her plan through Westminster is the dominant factor here. But there are grave concerns, aren't there, about what's going on in Italy, but also President Macron's grip on power after his climb down over the petrol taxes in France yesterday too.
That's absolutely correct. Macron is an innovator. He was a very innovative guy to start La Marche and to win, En Marche and win. But again, his popularity has plunged. There's been riots in the streets in Paris. People have died. It's a really not a good situation in France right now. But all three of these things, whether it's the instability of Macron's administration, the negotiations between the European Commission and Italy, and Brexit, all three of these are vulnerabilities in the European Union and the Eurozone itself. And so these deep vulnerabilities are rising to the surface. It points to political risk and more instability.
David, good to talk to you. Thank you very much for coming on the program. David Levine in North Carolina from the investment company Odin River.